Okay, folks, I got some major updates with my $430,000 dividend stock portfolio, which I invested another $5,000 over the last week, which we'll kind of extrapolate on toward the latter half of this video, but we got to roll it back. I mean, my God, what a wild week. Tesla Investor Day. I want to offer some updates around that because it was interesting the same day SpaceX launched people into space that night. Really cool stuff. We're going to talk about the Canadian financial sector with those wonderful, juicy dividend Canadian bank stocks because we finally got all the earnings and we want to kind of see what the landscape looks like with expected wave of defaults coming down the road, how bad the recession looks like, who the hell knows. And then we're going to kind of give you some insight into what I'm doing with this portfolio, my business outlook, and just the future of my plans. And if that is a conversation you'd appreciate, go down there and hit that like button. And while you're down there, you want to support the channel, you want to track your portfolio the same way I do here, go to portfoliospreadsheet.com, use coupon code dividends, and you'll get 30% off. But getting right into this, taking a broad view of the markets here, damn it, look at this, QQQ's up 2% today. I mean, SPY's up 1.5% across the board. We getting some juicy green into the end of the week, which is pretty nice to say the least. But we should talk about Tesla first and foremost here. Now, I get hate all the time. My most disliked videos are Tesla stock. I don't want people hate my opinion. It's just broad, it's general. I'm not saying much more than the media says anyways, like Tesla shares sink after Elon Musk's master plan fails to charge up investors. But this one's for the bulls because I'm going to explain to you how I'd go about buying Tesla stock because there's still a lot of hype. Even though I said the hype's dead, you can't take the hype away from the long-term bulls. I mean, listen to Sandy Munro, a guy that worked for GM, you know, a legend in the auto teardown industry.
That in probably about 3 years, maybe less, your shares, based on what I saw, are going to be worth about $1,000 each. No problem.
Now, I would love to hear the breakdown of how he's justifying that. Now, I think Tesla's going to be hands down one of the largest companies in the world. It will very likely be the largest auto company in the world. I think everything's going to become monopolistic about it because I don't think anyone's really competing with them. And then again, if you get self-driving, if you get robotics and all that stuff that isn't revenue generative yet come into play in the next 10 or 20 years, baby, we're talking about real money if you got a long-term mindset here. But when he says 3 years, this is the hype stuff that always bothers me about, like the crazy bulls, because, you know, if Tesla stock goes to 1,000 a share, that would put it at what, you know, another 4 or 5x the current market cap, giving it a $2.5–3 trillion valuation. And to put it in perspective, look at Apple that already sits near 2.4 trillion, right? That did almost 400 billion in revenue for 2022 and had gross profit of 170 billion compared to Tesla's 2022 81 billion and their gross profit of 20 billion. So I mean, he's got some super high expectations over the next 3 years. If we're purely just talking about the fundamentals, right? This is where the disconnect comes between the bulls and the bears. But I am long-term bullish no matter what on Tesla, just at the right price. I wish I picked it up down here. If I was smarter, I would have started cost averaging. So the only thing you can do, because this is such a hype stock, is if you love it, if you want to get in it, spend the next 6 to 12 months. Say, hey, if I got 5, 10, 15, 20 grand, I'm going to divvy it up over that 6 to 12 months and just buy a little bit every month. It's probably what I should be doing because I really do like Tesla stock. But putting that aside, guys, oh God, let's talk about this recessionary environment because Canada's biggest bank set aside a whopping $2.5 billion to cover an expected wave of loan defaults. How expected that is to be, who the hell knows? We don't know what the future is going to look like with the tumultuous market we're in with, you know, this crazy interest rate environment. So my exposure to the Canadian banks purely through VDY right now. I mean, I dumped 5 grand in here again during the week, and VDY did get hit on the Canadian banking earnings because all the Canadian banks pretty much went down with the exception of a few because of the terrible earnings. We'll talk about that in a second because for those of you that don't know, VDY, biggest holdings, 25%, Royal Bank, Toronto Dominion Bank, really concentrated monthly paying ETF. But I also get Bank of Nova Scotia, you know, 50% of this entire ETF is pretty much in the Canadian banks. Now, it's nice to see, as I mentioned, I think this is a buying opportunity of a lifetime. Since I've been saying that after earnings and the stocks crash, they're all rallying back. I mean, BNS was over a 6% yield, and it looks like people believe in that yield. Royal Bank, I mean, it didn't really dip too hard on its earnings, and it's almost fully bounced back. TD just posted earnings, and, you know, it's still kind of delayed to the rest of the bank stocks and recovering, but we're kind of getting the same story across the board. TD gets revenue lift as rising rates help U.S. margins, but reading into it, the retail banking in Canada and the U.S. paid off last quarter as rising interest rates made lending to consumers more profitable. That's my bull thesis. Over the long term, get rid of the shaky loans, and inevitably in a high interest rate environment, banks make more money, but concerns about its loan loss provisions and delays to a major deal weighed on the stock because, like Royal Bank purchasing HSBC, TD Bank may reprice its major acquisition for First Horizon. First Horizon, a huge company ETF. They do so much financial stuff. So that's just because, revenue's drying up across the board. But take a look at these earnings. Let me zoom my head out a little way a bit here. TD saw year over year EPS drop by 59% and quarter over quarter 77%. Oh, that sends chills down your spine if that's all you're looking at. From a revenue standpoint, however, they saw year-over-year growth of 8%, but quarter-over-quarter down 21%. All of this has been primarily just driven by loan loss provisions. As I keep saying, guys, the provision for credit losses has gone up pretty dramatically year over year by almost 300 basis points. That's not really that intriguing, but that's inevitably going to come to an end unless we head into a catastrophe like 2008, which I just don't see that happening. But I love these banks for this reason, guys. A lot of the revenues are still growing. Just on the Canadian banking segment, the revenues grew 17%. Population growth exploding in Canada right now. Lots of immigrants coming in. That wave is coming back after the insanity from the pandemic. And these banks are going to print. They're just going to get so many new clients. What did I say Royal Bank brought in the last quarter? Like 400,000 clients or something insane. So you got to love the Canadian banks, right? But kind of recircling this background, what are my plans here? What am I doing? It's coming down to a few facets. For me, pumping out these videos on this YouTube channel like religiously, it's getting so overwhelming because I'm focused so heavily on a marketing business that I do. And it goes well beyond just what I do on this YouTube channel. And I'm going to talk really in-depthly about it, probably on the weekend to my Patreon members. If you want to learn how I run my six-figure business, I mean, just support me on Patreon, $5 a month. I think that video is going to have a lot entailed to it if you want to learn what my industry is like. But primarily, I'm trying to get my dividends up to about $15,000 in annual income this year. And it's going to be interesting to how I go about doing that because there's just a lot at play with these stocks. I still have a lot of cash. The $5,000 I invested brought me down to about $28,000 in cash, which I'm just going to finish up taxes. Come April, I should have some RSP contribution where, another $8,000 will probably go into something like SCHD as I try and get my Schwab US Dividend Equity ETF to over $100,000 invested in value. And I want to get my VDY position to probably about $200,000. Probably not going to happen this year, but that's kind of like the long-term horizon plan that I have. And like I said, I'm just going to play the market as it goes. Somebody was asking me what it would take me to sell TSM stock. And honestly, it's really going to come down to the valuation metrics in it because TSM is just too cheap. I think it should easily be about $120 to $150 stock. And until we get there, I'm not really inclined to want to sell much of it because the dividend yield's very healthy on it. And it's just sitting at too good of a value. So I think, presuming we get over the Taiwan, Chinese invasion stuff, which I think is cooling down. China said they're not going to invade, if you can believe that. And the fact that Warren Buffett caused a lot of volatility, I think they're going to keep posting really good revenue numbers like they did in January. They were up 16% year over year. They post monthly numbers, seems to be how the chip industry works. I think if we can just subside some of the bad news, keep seeing these great numbers in a recessionary environment, the stock's going to recover. I could be wrong. It's speculative, not financial advice. But of course, I'll pass the question off to you guys. I'd love to know what you think about all this in that comment section below. And as always, stay cool, stay awesome.